The Munro Global Growth Fund returned negative 7.8% in the June quarter. The first half of 2022 has been the toughest start to any year since 1962, and the second quarter of 2022 remained particularly difficult for global equity markets. Consequently, the fund's long positions were the key detractor to performance. Pleasingly, however, the capital preservation tools, namely shorts, put options and FX, all contributed positively to the quarter and helped minimise the volatility during the quarter and the fund's overall drawdown. The quarter marked the official beginning of a bear market for many indices around the world. For some context, the MSCI All Country World Index drawdown was more than 20% during the quarter before a late quarter-end rally. From a stock attribution perspective, positive performance came from long positions in German defence company Rheinmetall and US managed care company United Health. The main detractors to performance on the long side were Amazon in the e-commerce area of interest, Microsoft in digital enterprise, and our high-performance compute beneficiaries AMD and Nvidia. Currency also contributed just under 3.5% to fund performance for the quarter, which is a result of the fund being positioned strongly in US dollars. During the quarter, the Australian dollar fell over 7%. It remains a difficult environment, and we continue to hold more than 40% of the fund in cash. However, bear markets are typically short, sharp and painful, and so in order to deploy that cash, we remain watchful of the following market indicators. Firstly, we would like to see a stabilisation or peak in long-term bond yields. In our view, bond yields can only go up so much as there is simply too much debt in the world today. We anticipate that the US 10-year yield will find it really difficult to go meaningfully past 3%. Secondly, we're looking for stocks to have attractive valuation multiples. Valuation multiples have derated significantly since the start of the year. Should long-term interest rates stop rising in a material way, we would expect to see an end to multiple compression. Thirdly, we are looking for an earnings expectation reset. We believe earnings for the market as a whole need to be revised downwards significantly as economic growth slows. We would like to see earnings expectations reset to give investors a clearer path forward for the market. The final signpost for us is simply time. So the average bear market typically lasts just under 300 days and falls 37% on average. Experience tells us to be patient in this environment and respect the history of previous down cycles. Longer term, our focus during these periods is always to use our risk management tools to the best of our ability to try and smooth the bumps for clients along the way. Despite drawdowns being painful, the current drawdown is not a completely new phenomenon, and experience in markets tells us that stocks will ultimately go back to following their earnings in the long run. We believe the market will ultimately come back to rewarding those companies with resilient earnings growth, backed by a structural tailwind. And we remain excited about some of the opportunities going forward that the current bear market is presenting.